Disclaimer.
While you're staring at silver charts hovering near $100 and wondering if it's too late to buy, the game is already over. Right now, on this quiet Monday, January 19th, a number has appeared on the official U.S. Mint website that should make every investor's blood run cold: $173 per ounce. This isn't a glitch, and it isn't just a premium. It is a sovereign confession. The U.S. government has just signaled that the paper market is dead. And if you think 173 is shocking, analysts are now projecting physical silver could hit $150 to $200 per ounce once export controls kick in across Latin America. With Mexico and Peru signaling a move toward BRICS, the world's primary silver faucet is being turned off for the West. You aren't watching a price rally. You're watching the total thermal detonation of the financial system. You have less than 24 hours before the opening bell on Tuesday to understand what is really happening here. Picture this scenario. You wake up tomorrow morning to headlines announcing Mexico and Peru have officially joined BRICS. Your first thought might be, so what? That's just international politics. But here's what should immediately grab your attention. Those two countries alone control 35% of the world's silver production. Not copper, not oil, not some abstract commodity you've never heard of. Silver, the metal currently sitting inside your smartphone, your solar panels, every electric vehicle battery, and the massive data centers powering the AI revolution everyone keeps talking about. Now let me ask you something. What happens when the countries producing more than a third of a critical industrial metal suddenly align themselves with a bloc that's openly building an alternative to our dollar-based trading system? We're about to find out, and the answer involves a supply shock that could make the semiconductor shortage of 2021 look like a minor inconvenience. Here's where this story really begins. In July 2025, Mexico attended the BRICS summit in Rio de Janeiro as an observer nation, not a full member, just watching from the sidelines. But anyone paying attention to geopolitical chess moves understood what that invitation actually meant. BRICS was making its pitch to one of our largest trading partners, a country that sends us $500 billion worth of goods annually. Then, in November 2025, Peru's Congress introduced a formal bill proposing BRICS membership. Two Latin American nations, both massive silver producers, both suddenly showing serious interest in joining a bloc that Russia, China, India, Brazil, and South Africa built specifically to challenge Western economic dominance. You might be wondering why silver matters so much in this equation. Let me put this in perspective for you. According to the Silver Institute, global silver demand hit 700 million ounces in 2025. Industrial applications, the stuff that actually powers modern technology, consumed more than half of that supply. Solar panel manufacturers need silver paste to create electrical conductivity in photovoltaic cells. Electric vehicle makers require silver in battery systems, charging infrastructure, and electrical contacts throughout the vehicle. The explosion of artificial intelligence created unprecedented demand for silver in data center infrastructure, where servers and cooling systems rely on silver's unmatched electrical and thermal conductivity. But here's the problem that should concern every American watching this. Silver markets have been running a deficit for 5 consecutive years straight, from 2021 through 2025. Not a slight imbalance we can easily fix. We're talking about a cumulative shortage of 820 million ounces. That's more than an entire year's worth of global production simply vanishing from available supply. Think about what that means for a moment. For 5 straight years, the world has been consuming more silver than miners could dig out of the ground. What happens when supply can't meet demand? Prices explode upward. Silver started 22.20, trading around $18 per ounce. By January 2026, spot prices have surged nearly 200%, blasting past $85 per ounce and hitting a record high of $92 in mid-January. Industrial buyers who locked in long-term contracts at $25 per ounce suddenly found themselves competing for physical metal at prices nearly 4 times higher. Now here's where things get genuinely alarming. While prices were skyrocketing, the physical inventories backing our entire silver trading system started collapsing. COMEX warehouses in New York, the exchange where most silver futures contracts trade, saw inventories drop 70% from peak levels. The London vaults, which traditionally hold massive silver stockpiles for global trade, watched their reserves decline 40%. These aren't abstract numbers on a spreadsheet. These are the actual physical ounces that back up the paper contracts industrial buyers depend on to secure their supply chains. Mexico and Peru sit at the absolute center of this tightening supply situation. Together, they mine approximately 340 million ounces annually, more than a third of everything the world produces. When you add in the rest of Latin America, the region controls 55% of global silver output. That's not diversified production, spread across dozens of countries. That's concentration of a critical resource in a region that is increasingly questioning its relationship with the United States. Let me show you what happens when major producers start restricting exports. On January 1st, 2026, China implemented sweeping new silver export controls. The regulations required exporters to demonstrate 80-ton annual capacity and obtain government licenses before shipping any silver outside the country. The practical effect? Hundreds of smaller Chinese exporters got cut off overnight. The country that had been supplying physical silver to global markets suddenly created an artificial shortage through regulatory barriers. The price divergence that followed revealed something absolutely crucial about how BRICS could weaponize silver. In Shanghai, where domestic Chinese buyers compete for limited supply, physical silver started trading above $80 per ounce. Meanwhile, COMEX futures in New York, the paper contracts that supposedly represent claims on physical silver, lagged far behind at $30 to $35. The $45 gap between physical metal and paper promises exposed the illusion that has been propping up our commodities markets. When push comes to shove, you can't manufacture silver out of thin air just because a futures contract says you own it. China just demonstrated the exact playbook BRICS could deploy across Latin American producers. Think about the strategic brilliance of that move for a moment. By restricting exports through licensing requirements and capacity thresholds, you create a two-tier market where domestic industry gets priority access at controlled prices, while foreign buyers scramble for shrinking supply at whatever price the market will bear. You're not technically embargoing anyone. You're just making sure your own industrial needs get met first. Now imagine Mexico and Peru implementing similar restrictions. Not a dramatic announcement or explicit embargo, just a new regulatory framework requiring mining companies to prioritize domestic processing or export licensing that favors BRICS trading partners, or environmental standards that conveniently slow down shipments to Western buyers. The results would be functionally identical to what China just accomplished, except applied to 35% of global supply instead of China's smaller export volumes. You need to understand something critical about silver mining that makes this situation even more dangerous. 75 to 80% of silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. Mining companies aren't digging primarily for silver, they're extracting copper deposits that happen to contain silver as a secondary product. This creates a bizarre supply dynamic where silver prices can triple or quadruple, but production doesn't significantly increase because miners are making extraction decisions based on copper prices, not silver prices. Peru holds 140,000 metric tons of proven silver reserves, the largest on the planet. Mexico's reserves stand at 37,000 metric tons, but many of Mexico's most productive mines are aging and showing depletion. That asymmetry matters enormously because it means Peru has decades of production capacity ahead, while Mexico faces declining output unless massive new discoveries come online. For BRICS, that makes Peru an even more valuable long-term partner than Mexico for securing silver supplies. Here's what you need to grasp about the timeline we're facing. These aren't hypothetical scenarios decades in the future. Mexico attended the July 2025 BRICS summit just months ago. Peru's Congress proposed BRICS membership in November 2025. China implemented export restrictions January 1st, 2026. Literally weeks ago from when you're watching this. The pieces are already moving on the chessboard, and the Western response has been largely to pretend this isn't happening. Think about your own exposure for a moment. If you own solar panels, you're depending on continued silver availability for future expansions or replacements. If you're invested in electric vehicle stocks, you're betting on supply chains that require steady silver inputs. If you hold shares in technology companies building out AI infrastructure, you're exposed to data center construction that consumes enormous quantities of silver. If you're saving for retirement in index funds, those funds hold positions in all these silver-dependent industries. The deficit we're experiencing right now, 149 million ounces annually, already pushed prices from $18 to $92. That deficit exists with Mexico and Peru still primarily serving Western markets. Now do the math on what happens if 35% of global supply suddenly prioritizes BRICS trade relationships over dollar-denominated contracts with American and European buyers. The deficit doesn't just increase incrementally, it explodes into a crisis that forces Western industry to compete for scraps of supply at prices analysts are now projecting could reach $150 to $200 per ounce. The U.S. Mint pricing at $173 is not speculation anymore. It's the government telling you what physical silver actually costs when paper markets collapse. We're watching the early stages of commodity weaponization in real time, not through dramatic military action or explicit embargoes that would make headlines, through quiet diplomatic alignments, regulatory frameworks that favor certain trading partners, and the patient construction of alternative trading systems that don't depend on dollars or Western financial institutions. The question isn't whether this could happen. The question is whether we're prepared for what happens when it does. You want proof that BRICS isn't just talking about de-dollarization, that they're actually building the infrastructure to pull it off? Let me show you exactly what happened on October 31st, 2025, while most Americans were focused on Halloween candy and costume parties. BRICS launched something called the Unit. Not a proposal, not a white paper, not another round of diplomatic discussions. An actual working prototype of a commodity-backed digital settlement currency. The formula is brilliantly simple and terrifyingly effective. 40% backed by physical gold and silver, 60% backed by a basket of BRICS national currencies. This isn't theoretical economics anymore. This is operational infrastructure, designed to settle trillions of dollars in trade without ever touching the US dollar or our banking system. Think about the timing of that launch for just a moment. October 31st, 2025. Right as silver was beginning its historic surge, right as China was preparing to implement export controls, right as Mexico and Peru were deepening their engagement with BRICS. That's not coincidence, that's coordination. The International Research Institute for Advanced Systems issued 100 units as an initial pilot, with each unit pegged to 1 gram of physical gold. They published the technical specifications on the Cardano blockchain network for full transparency. This is real money, backed by real commodities, ready for real international trade. But here's where it gets even more interesting. According to data from multiple sources tracking central bank activities, BRICS nations dumped $28.8 billion in U.S. Treasury holdings throughout 2025. $28.8 billion of our government debt sold off systematically while they were building this alternative system. You don't liquidate that much Treasury exposure unless you're preparing for something fundamental to change in how global trade gets settled. Now, let's talk about gold for a second because it directly connects to the silver story you need to understand. BRICS nations collectively control approximately 50% of global gold production through strategic partnerships and direct mining operations. Russia leads with 2,336 tons in reserves. China holds 2,298 tons. India has 880 tons. Brazil added 16 tons in September 2025, their first gold purchase since 2021. These countries aren't just producing gold, they're systematically accumulating it while building a currency system backed by it. The unit combines this gold dominance with the exact same strategy they're preparing to deploy for silver: create commodity-backed money that doesn't require Western banks, Western clearing systems, or Western approval. Then use your control over commodity production to make that system irresistible to trading partners. President Trump explicitly threatened BRICS with 100% tariffs if they move forward with the unit. His response proves that Washington understands exactly how dangerous this system is to dollar dominance, but threatening tariffs doesn't change the mathematical reality. BRICS controls the commodities, and commodities are what the global economy actually runs on. Let me show you how Mexico fits into this chess game, because understanding Mexico's position reveals why BRICS is winning this quiet war. Mexico sent Foreign Minister Juan Ramón de la Fuente to that July 2025 Rio summit. Officially, Mexico claimed they were just observers with no intention of joining. But diplomatic sources reported something very different was happening in those closed-door meetings. Mexico held bilateral discussions with Brazil, India, China, and Russia, all the major BRICS players. They weren't there to observe. They were there to negotiate. Here's what you need to understand about Mexico's economic reality right now. They send $500 billion worth of goods to the United States annually under USMCA trade agreements. That makes us their largest trading partner by an enormous margin. But President Trump has repeatedly threatened to blow up those agreements with punitive tariffs, claiming Mexico is taking advantage of us. Whether you agree with that characterization or not, the threat itself creates enormous pressure on Mexico to diversify away from dependence on the American market. Enter Russia with a solution. Throughout 2025, Mexican business lobbies pushed aggressively for deals to import Russian liquefied natural gas. Not because Mexico needs Russian energy. They have plenty of domestic production. Because Russia offered prices and terms that undercut American suppliers, and because those deals came packaged with discussions about broader trade relationships that don't require dollar settlement. The Mexican business community started asking very loudly why they should remain locked into dollar-denominated trade when alternatives exist that might be more stable and less subject to political threats from Washington. USMCA comes up for review in 2026. That's not some distant future event. That's happening right now this year. Mexico faces a choice: renegotiate under hostile conditions with an American administration threatening tariffs and trade wars, or hedge their bets by developing alternative trading relationships through BRICS that give them leverage in those negotiations. Which would you choose if you were running Mexico's economy? Now look at Peru, because their situation is even more stark. In November 2025, Congressman Waldemar Cerrón introduced Bill 13118 in Peru's Congress, formally proposing BRICS membership. And this wasn't some fringe politician making noise. This was a serious legislative proposal with backing from multiple parties, calling it a matter of national interest for Peru to integrate with BRICS economic mechanisms. The bill directs Peru's foreign ministry to pursue membership, and specifically mentions joining the BRICS New Development Bank. Peru holds 140,000 metric tons of proven silver reserves, 22% of everything the world has in the ground. They are the Saudi Arabia of silver, and they know it. While Mexico's reserves are depleting and their mines are aging, Peru is sitting on decades' worth of production capacity. That gives them enormous leverage in any negotiation about who gets access to their silver and at what price. The Peruvian government stated explicitly in that legislative proposal that they're watching a profound reconfigurations in the international order, and that Peru lacks a coherent strategy for the new multipolar world. Translation: they see the writing on the wall about American economic dominance declining, and they want to position themselves advantageously before that shift accelerates. They're watching countries like Saudi Arabia, UAE, and Indonesia join BRICS and gain access to alternative financing, alternative trade routes, and alternative currency systems that reduce their exposure to dollar volatility and U.S. political pressure. Both Mexico and Peru hold massive leverage cards. Mexico controls $500 billion in annual exports to the United States. Lose that, and our supply chains collapse overnight. Peru controls 22% of global silver reserves. Lose access to that, and our technology sector faces shortages in everything from solar panels to semiconductors. BRICS understands this leverage better than Washington seems to, and they're making their pitch accordingly. Let me explain something technical about silver mining that makes this situation catastrophically dangerous for Western industry. 75 to 80% of all silver that gets mined comes out of the ground as a byproduct. Miners aren't digging for silver specifically. They're mining copper, zinc, lead, and gold, and silver happens to show up in those ore deposits as a secondary product. What does that mean in practice? It means silver supply is almost completely unresponsive to silver prices. When copper prices are low, copper mines slow down or shut down. The silver that would have come as a byproduct simply doesn't get produced. When silver prices triple or quadruple, it doesn't matter. If copper prices aren't high enough to justify running the mine at full capacity, that silver stays in the ground. You can't just open a silver mine to respond to high silver prices, because pure silver deposits are relatively rare and take over a decade to develop from discovery to production. Peru produces about 110 million ounces annually, most of it from copper and zinc operations in the Andes. Mexico produces about 232 million ounces annually, again mostly from polymetallic mines where silver is the byproduct. Neither country can quickly ramp up production even if silver hits $200 per ounce, because their mining decisions are driven by base metal economics, not precious metal prices. This is why export controls are so devastating. When China implemented licensing requirements on January 1st, they didn't ban silver exports outright. They just made it really, really difficult for anyone except large, state-approved companies to export. The requirement for 80-ton annual capacity immediately disqualified hundreds of smaller exporters. The requirement for substantial credit lines and consistent export history from 2022 through 2024 disqualified hundreds more. China effectively created a two-tier system. Domestic industry gets all the silver it needs at reasonable prices, while international buyers compete for scraps from the few approved exporters at whatever prices the market will bear. Now imagine Mexico and Peru implementing similar systems. Not an outright ban, nothing that would trigger immediate sanctions or trade retaliation, just a new regulatory framework that requires environmental impact assessments before export approval, or export licensing that prioritizes sales to BRICS trading partners, or new refining requirements that give preference to domestic processing facilities. The effect would be identical to what China accomplished. Western industrial buyers would suddenly find themselves competing for 35% less silver on the global market. With no ability to quickly develop alternative sources because of that byproduct supply issue. You're probably thinking this sounds paranoid, like conspiracy theory speculation about things that might happen someday. So let me give you the data that shows it's already happening. According to the World Gold Council and multiple commodity tracking services, BRICS nations have systematically accumulated more than 50% of all gold purchases by central banks between 2020 and 2024. That's the longest continuous precious metals buying spree in modern financial history. They're not accumulating gold because they think it's pretty. They're accumulating it because they're building a commodity-backed monetary system and they need the physical reserves to back it up. China's silver export restrictions went live on January 1st, 2026, 3 weeks ago. The divergence between Shanghai physical prices and COMEX futures prices widened immediately to $45 per ounce. That gap represents the difference between real silver you can actually hold and paper promises that may or may not be backed by anything. When the U.S. Mint reprices their silver eagles to $173, while COMEX futures trade at $90, that's not the Mint being greedy. That's the Mint telling you what it actually costs to acquire physical silver in the real world versus the fantasy prices on the futures exchange. The BRICS unit launched on October 31st with 40% commodity backing. Mexico attended the July BRICS summit. Peru proposed membership in November. China restricted exports in January. These aren't separate random events. This is a coordinated strategy unfolding in real time, and the target is clear. Break the dollar's monopoly on international trade by controlling the physical commodities that industrial economies actually need to function. Silver isn't just a precious metal anymore. It's a weapon in a global economic war, and the countries that produce it are choosing sides. Now let's do the math that should absolutely terrify anyone who understands supply and demand. We're going to walk through the numbers step by step, and by the end, you'll understand exactly why the U.S. Mint pricing at $173 is an anomaly. It's a warning shot about where this market is heading. Start with the baseline. Global silver deficit right now stands at 149 million ounces annually. That's the gap between what the world consumes and what miners can produce, even with silver trading at $92 per ounce. Industrial demand keeps growing because solar installations are accelerating, electric vehicle production is ramping up, AI data centers are multiplying, and every single one of those technologies requires silver in quantities that simply cannot be substituted with anything else. Now here's where the calculation gets truly frightening. Mexico and Peru together produce approximately 340 million ounces annually, 35% of total global production. What happens if those two countries implement export licensing, similar to what China just rolled out? Let's be conservative and assume they don't cut off exports completely. Let's say they implement regulations that reduce exports to Western markets by 60% while prioritizing BRICS trading partners and domestic industrial use. 60% of 340 million ounces is 204 million ounces that suddenly become unavailable to American and European buyers. Take the existing 149 million ounce deficit and add 204 million ounces of lost Mexican and Peruvian supply. You get a 353 million ounce annual shortage. That's not a deficit anymore. That's a catastrophic supply crisis. To put that in perspective, 353 million ounces represents roughly 37% of total global production. You've essentially removed more than a third of the world's silver supply from Western markets in a single policy shift. What does that do to prices? We've already seen silver go from $30 to $92 on a 149 million ounce deficit. Now more than double that deficit. Industrial buyers don't have the luxury of waiting for prices to come down. Solar panel manufacturers need silver paste. Right now, EV makers need it for battery systems right now. Data center operators need it for server infrastructure right now. They either pay whatever price secures supply or their production lines shut down. This is why analysts are projecting $150 to $200 per ounce as the new equilibrium price if Mexico and Peru align with BRICS export strategies. Some commodity strategists are privately discussing scenarios where physical silver could spike to $250 or higher because industrial panic buying would create a temporary shortage far beyond the mathematical deficit. But here's the part that keeps me up at night. The long-term supply can't adjust quickly enough to matter. You can't just decide to open new silver mines to respond to high prices, because primary silver deposits are rare and developing a new mine from discovery to production takes 10 to 15 years minimum. By the time any new supply comes online, we'll have gone through years of 350 plus million ounce annual deficits. The cumulative shortage would exceed billions of ounces. Let me show you the timeline that makes this scenario not just possible, but increasingly probable. BRICS Pay settlement mechanism targets a 2028 to 2030 launch. Mexico faces USMCA review in 2026, this year, with Trump already threatening massive tariffs. The worse those negotiations go, the more attractive BRICS membership becomes as a hedge. Peru's congressional bill includes a one-year timeline for diplomatic implementation, putting us in 2026 for initial steps and 2027 for potential full membership. So the convergence point is 2026 through 2027. That's the critical window where Mexico and Peru must choose. Stay aligned with a dollar-based system increasingly weaponized through tariff threats, or join a commodity-backed alternative that gives them more leverage. From pure economic rationality, the choice seems obvious. Align with the bloc that controls 50% of gold production, 47.9% of global population, and is building payment systems specifically designed to benefit commodity exporters rather than financial centers. Think about silver's role in the technologies that define the 21st century economy. Solar panels require silver paste for electrical conductivity. There is no substitute material that works as efficiently at industrial scale. Electric vehicles need silver in battery connections and charging systems. Semiconductors use silver in die-attached materials, critical for the chips that power everything from smartphones to weapon systems. AI data centers consume enormous quantities of silver in server infrastructure, and data center construction is accelerating globally as the AI arms race intensifies. Every single one of these technologies is strategic. Every single one is essential to Western economic competitiveness and national security. And every single one is completely dependent on steady silver supply. That makes silver the perfect pressure point for BRICS to apply leverage. Cut Western access to 35% of global supply. Watch prices explode, watch industrial production slow, watch technology supply chains seize up, all without firing a shot or launching a missile. Economic warfare through commodity control. Let me give you one data point that shows how far dollar displacement has already progressed. In the 1970s, the US dollar represented 85% of global foreign exchange reserves. By 2024, that share had fallen to 58%. The dollar is still dominant, but the trend is unmistakably downward. Meanwhile, BRICS has expanded to 10 full members plus 13 partner countries, representing nearly half of global population and growing influence over critical commodity markets. Now add silver to that equation. If BRICS can control access to the silver that Western technology depends on, they create a commodity lever to force de-dollarization. Countries that want reliable access to silver for their solar industries, EV manufacturing, and tech sectors would face enormous pressure to join BRICS payment systems and hold commodity-backed units instead of dollars. This is why the U.S. Mint repriced silver eagles to $173. It's not just reflecting current market conditions. It's preparing for a world where physical silver becomes so scarce and strategically important that official government pricing has to acknowledge the gap between paper contracts and physical reality. When your own government is pricing silver at $173, while futures markets trade at $90, that's an admission that the paper market has become divorced from physical supply and demand. You need to understand something crucial as we close this out. I'm not telling you this to create panic or to convince you to rush out and buy silver at any price. I'm telling you this because American investors, American businesses, and American policymakers need to understand the chess game being played on the global stage. BRICS isn't going away. Commodity weaponization isn't going away. The trend toward de-dollarization isn't going away. These are structural forces reshaping the global economy, and pretending they don't exist won't make them disappear. The window we're in right now, 2026 through 2027, represents a critical inflection point. Mexico's USMCA review, Peru's BRICS membership timeline, and BRICS pay implementation are all converging. The decisions made in the next 12 to 18 months will determine whether Western economies maintain access to the silver supplies that our technology industries require, or whether that access becomes conditional on playing by BRICS rules and using BRICS payment systems. This isn't about fear. This is about awareness. This is about understanding that the world is changing, that commodity control is becoming a weapon in global economic competition, and that the countries producing critical materials are increasingly willing to use that leverage to advance their own interests. The price of silver is not just moving up because of supply and demand. It's moving up because silver has become strategic, because it's being weaponized, and because the countries that produce it see an opportunity to reshape the global economic order. $173 per ounce from the U.S. Mint, $92 spot prices hitting all-time records, $150 to $200 projections from serious analysts, 340 million ounces of production concentrated in 2 countries actively courting BRICS membership. A 353 million ounce deficit if export controls kick in. Strategic technologies with no viable silver substitutes. A critical timeline converging in 2026 through 2027. Do the math. Draw your own conclusions. But don't say you were warned when the world's primary silver faucet gets turned off for the West and our technology supply chains start seizing up because we ignored the warning signs that were flashing bright red right in front of us.